I want to talk to you today about something that so many people heading into retirement or already living in retirement think they can completely ignore. I hear it all the time. Susie, I'm 65. I'm 70. I paid off my mortgage, my car is sitting in the driveway paid for, and I'm done borrowing money. Why on earth should I care about my credit score? Listen to me. That mindset right there is one of the most dangerous financial traps you can fall into in your golden years. You think you don't need credit because you aren't planning to buy a brand new sports car or a bigger house. But what happens if you decide to downsize into an apartment or a retirement community? They run your credit. What happens if you want to switch your auto insurance or home insurance? In almost every state, insurers use your credit score to set your premiums. Your credit score is your financial report card for life, people. It is not just about borrowing money, it is about your security, your options, and your peace of mind. Now, maybe life happened. Maybe you had medical bills, maybe you went through a tough divorce, or maybe you simply closed down all your credit cards because you thought you didn't need them anymore, and now your credit score has tanked or disappeared entirely. So you start looking around for help, and you see this company popping up everywhere called Kikoff. You see the advertisements promising to build your credit score quickly, safely, with no credit checks and for as little as $5 a month. And you ask yourself, first, let us talk about how Kikoff actually works, because I never want you to put your hard-earned dollars into anything you do not understand. Kikoff is not a traditional credit card company, and it is not a bank giving you a big personal loan. Kikoff is a credit-building service. When you sign up for their basic plan, which costs $5 a month, Kikoff gives you what is called a revolving line of credit. Usually, it starts at around $750. But here is the catch that trips so many people up. You cannot take that $750 and go to the grocery store, buy gas, or take your grandkids out to dinner. Why do they do this? Because Kikoff takes that record of your on-time payments and reports it every single month to the three major credit bureaus, Equifax, Experian, and TransUnion. Now, let us look at the pros. Why might Kikoff be a good tool for someone in or near retirement? Pro number 1. There is no hard credit check. If your credit score is currently in the 500s, or if you have no credit score at all because you haven't used credit in 10 years, traditional banks will turn you down flat. Every time they reject you, that hard inquiry knocks your score down even further. Pro number 2. It targets the two biggest drivers of your credit score, payment history and credit utilization. Payment history makes up 35% of your FICO score. By putting Kikoff on autopay for $5 a month, you automatically log 12 perfectly on-time payments every single year. Credit utilization, how much credit you are using versus how much you have available, makes up another 30% of your score. Because Kikoff gives you a $750 credit line and you are only using a few dollars of it each month, your utilization rate looks extraordinarily low, which can give a quick boost to a beat-up credit score. Pro number 3. Zero interest and zero hidden penalty fees. I despise financial products that trap vulnerable seniors in high-interest debt cycles. With Kikoff's basic credit account, there is 0% APR. You are not accumulating interest charges that roll over month after month. What you see is what you pay. Pro number 4. They offer extra features that fit real retirement expenses if you move to higher tiers. Their higher tier plans offer rent reporting and bill reporting. If you are renting your home or paying monthly utility bills like electricity, gas, and water, Kikoff can report those on-time payments to the credit bureaus as well. That means getting credit for money you are already spending every single month. Do not go signing up just yet, because we need to talk about the cons. And you know me, I am always going to tell you the truth, whether you want to hear it or not. Con number 1. It is a recurring monthly fee for a product with no cash utility. You are paying $60 a year on the basic plan, or up to $240 to $420 a year on their premium and ultimate plans for what is essentially a simulated credit account. You cannot buy groceries with it. You cannot pay for a medical emergency with it. If you are on a very strict, fixed Social Security income where every single dollar counts, paying a monthly subscription fee just to report data to a credit bureau might feel like paying for something you could achieve elsewhere for free. Con number 2. It does not build a cash savings balance. Some credit builder programs out there operate like a credit builder loan, where your monthly payments go into a locked savings account or CD that you get back at the end of the term. Kikoff's basic subscription fee is a fee. You do not get those $5 a month back when you close the account. It is a cost of service. Con number 3. Kikoff has limited usefulness if you already have decent credit. Listen to me very carefully. If your credit score is already 700 or above, Kikoff is not going to magically jump your score to 850. Kikoff is designed primarily for people who are restarting from scratch or repairing serious damage. If you already have active credit cards that you pay off in full every month, adding a small $750 Kikoff line is barely going to nudge the needle for you. However, if you have a few $100s sitting safely in your emergency fund, an even better option might be a zero annual fee secured credit card from a reputable bank or credit union. With a secured card, you put down a refundable deposit, say $200 or $300, and you use that card to buy actual groceries or gas once a month, paying it off in full every single month. You pay zero subscription fees, you build real credit with real-world spending, and when you graduate to an unsecured card, you get your deposit back. Do not let fear keep you from managing your financial health in retirement. Your credit score is a tool that protects your independence, your monthly expenses, and your peace of mind. Choose the tool that fits your budget, keep your payments automatic, stay out of high-interest debt, and remember, you have worked too hard for your money to let simple credit fixes confuse you. You can do this, and you can stand financially strong.